Good morning, everyone. This is Kathy McBreen from the Spectrum Group. Welcome to our webinar, our monthly webinar about our index and some of our research. We're hoping everyone had a great 4th of July holiday, and we're excited to share with you some of our findings from this particular month. With us today, I have George Walper, the president of Spectrum Group, and he's going to talk to us a little bit today about our monthly Millionaire and Affluent Investor Index, and then we're going to talk briefly about some research that we just pulled out of the field on advisor preferences by investor profiles. So with that, I'll turn it over to George.
Good morning, everyone. This is an interesting month for our index. Sometimes timing is everything. Sometimes you hit perfect timing, sometimes you don't. This was fielded, or meaning we asked folks the survey questions right before the final vote for the Brexit announcement in Europe and the UK was announced. So a number of these optimistic figures we think could have been influenced had this been done the Monday and Tuesday when the market had significant volatility. But at the same time, when the markets bounced back somewhat, sometimes the index is influenced by 2 or 3 days over a month. So the numbers we're going to talk about here is prior to the announcement of the vote. It actually was also most likely influenced by the fact that prior to this time, all the polling indicated that the UK was going to vote to stay in the EU. So it will be clearly interesting to see what happens next month. When we look at the index, for those of you that are somewhat familiar with it, we look at two categories: the overall affluent market, which is investors with $500,000 in net worth and above, not including their primary house or their primary residence. And then we look at the millionaire market, which is above that. So you see that when you compare this month to last month, you see that it is trending upward 4 points and from last month, and then compared to a year ago, it's also up. So that's kind of interesting. It's also been trending upwards in a positive directions for the 6 months of this year. So we always like to look at trends, and as you can tell from my opening comments, 1 month at a time is kind of depending on what news or what events or what market swings are happening to them. The other thing that just put context around these numbers, because it's always a pretty narrow band, this is actually on a 200-point scale from minus 100 to plus 100. So you see the Millionaire Index at 9 and the Spectrum Affluent Index at number 4. That's what those numbers indicate. For those of you that have seen this in the past, and for those of you that haven't seen this before, I in particular like to talk about the past 12 months, which is the upper part of this chart, and then the bottom part is the history of this back to 2004. Even in 2016 and the last half of 2015, you see the continued sort of roller coaster volatile ride that wealthy investors experience on any given month to month. And we think it's important to think about trends. So if you look at, so now we're trending back up this past month after a couple down months, but the previous 3 or 4 months we're trending upward. That's an important factor, is the trends. And we would expect to see an impact next month from both the volatility of the markets after the announcement of the vote, but more importantly, what's going to happen here in the next few months. A key component to the index is what we describe as the affluent household outlook. It's essentially what do these investors think about a number of categories. This particular category has more detail when you look at the next subcategory, the next page here, where we look at a number of subcomponents: their overall outlook, which was the previous chart that we just had looked at, how they feel about the income in their household, their overall thoughts about the economy and the impact the economy will have for their family or their house, the health of their employer, either their own company if they own it, or in some cases who they work for, and then their overall assets. And you see some very interesting trends here that, in particular, what we think are the most critical, income and the economy, are trending downwards. And yet, at the same time, how they feel about their company health, either the company they own or who they work for, is trending upwards. So you see some very mixed signals in there. And this is, I think, the most important factor to look at. We should have also said that in the beginning, today's call. If you have any questions, just click on the little button there that says questions, and we'll see them and talk about them as they come up. This year, given the fact that it's a presidential election year, we're looking at all of these insights based on how folks indicate their political leanings are between Republican, Democrat, and Independent. And as we've seen the last few months, you start seeing some significant differences in this overall outlook relative to the economy, where you see Republicans have a very pessimistic view of the economy and the impact the economy will have on their house, their investments, etc., compared to Democrats. I mean, that's a 60-point difference, which is quite significant in an index of this nature. And then independents are just about in the middle. You see some differences in terms of company health, just a little bit, household income, but the impact of the economy sways the overall outlook of their households. So you see that, and then you start looking at some of our rotating questions that we say, what are the most important threats to your household achieving goals? And right now it's being driven by three major factors. The economy, as we've talked a lot about, the political climate, and the market conditions. We will expect the political climate to become sort of the hot topic for the remainder of this year up until the election in September. You can see when we look at the same question looking backwards over time, all the way back to March of 2015, political climate's been somewhat flat. You'll start to see that go up. The market conditions will become a factor here if the volatility continues, especially as the election heats up and also depending on the European Union issues with the UK starts to become more of a news item. In addition to the outlook, a key component, this is really particularly important to advisors at your companies, your own investment internal groups, etc. In terms of, we always ask questions to investors. So what are you going to invest in the next 6 months? This is important for one, to get a pulse for what your clients think. Secondly, if it's significantly different than your own asset allocation decisions for your clients, or more importantly, what you're talking to your clients about, we would say pause a little bit and say, this is what your clients think they want to invest in, and contrast it to what you're doing and have those conversations. Equities are starting to trend up a little bit when you look at stocks, and then individual stocks and equity mutual funds, a little bit of an uptick this month. Fixed income down somewhat. Cash, and we'll see cash here in a little bit more detail, and then real estate's tracking up. So those are all sort of pulses. When we look at the same thing from a political party, what's interesting is when you think of the significant difference about how people feel about the economy based on their political preferences. Yet, at the end of the day, they're somewhat investing similarly, especially when you look at equities, where you start to see some differences is around cash, and more importantly, sort of what we call being on the sidelines, not investing. But at the end of the day, they may have different views about what's happening in the markets and the economy, but they're investing the same way. So it's kind of an interesting dynamic when you start looking at the political affiliation of these investors.
George, we have a question. The question is asking you, what do you anticipate will happen with some of these investment preferences throughout the fall as we go through the election cycle?
I think you'll start to see if the candidates start talking about their economic policy in more detail, or if they have the courage to talk about economic policy in more detail. There might be some reaction, but to be honest with you, I think what will drive some of these reactions will be more what the market does. And again, the market's going to be influenced by if there's any specificity, because at the moment there's no specificity. There's just a lot of nice conversation. But we will have to see what happens relative to if people have the courage to get detail out on their websites, the candidates, and in their debates, what happens. This might influence their investing. We're going to shift now to a piece of interesting research that we just have published that Kathy will talk about.
Great, thank you, George. We just published a report called Advisor Preferences by investor profiles. Now that's a really exciting and catchy title, we know, but we're trying to be very descriptive about what it is. And what this report is about is, are there do different types of people automatically choose different types of advisors? Are there certain kinds of investors that will always automatically go to a financial, for example, a financial planner, versus those who are going to go to somebody who's an investment manager, versus those who might go to an online broker? And some of those are more obvious than others. But we thought that it would be interesting to look at people and how they chose the advisors that they had chosen, and were there certain similarities about those different types of investors. So we looked through our whole year's worth of research. So roughly we'd have more than 3,500 households that we had interviewed over the last year, that we looked at who they chose and then tried to cluster them into groups of what were interesting facts or interesting trends that we found about those different types of individuals. This would include households that had $100,000 of net worth up to $25 million. And then we would have taken those and made sure that we have the appropriate segmentation in each group. So if you want to take a look at page 15, the first thing that we wanted to introduce to you is the fact that there are different advisor types used by wealth segment. So the top advisor types in each of the different wealth segments that we generally look at are published here. So you can see the full service broker in all three segments is the most popular type of investment advisor. And then in the mass affluent, the independent financial planner is second, compared to the online broker and the ultra high net worth, which you say, what is that about? And a lot of that has to do with some of the tendency of some of the younger, very wealthy households to try to kind of be sort of self-directed. You'll also see in the ultra high net worth, those are with more than $5 million, an accountant often shows up as one of the most important advisors. And that's because a lot of these people will be business owners, and so they would depend upon their accountant for everything. The other thing that's an interesting one to look at is if you take a look at the mass affluent and you see that the banker comes in number 3. What's important is that bankers, for a lot of these people, especially mass affluent, you'll have younger households. They're people who put their money in the bank. They're just starting to get enough assets to really think about what it is that they really want to do with it. And they're great opportunity for banks to be able to reach out and start to take care of these households, even though they haven't always been successful at doing that. So those are the types of different kinds of individuals we looked at. We sorted them by what different types of advisors they were using. So if you take a look at page 16, one of the things that we ask all the time is your financial situation today better than it was a year ago? If you take a look at this, the people who have a mutual fund company represented as their primary advisor, they're the ones that are happier about their financial situation, which is kind of interesting. You would hope that it would have been the more full-service brokers who had the happiest clients, but they kind of fall in there at one of the lower percentages. Those with the banker as their primary advisor are less happy than some of the others, and independent financial planners are happier, and discount online brokers. So it seems like a lot of these people that are kind of do-it-yourselfers are feeling kind of good about the way that their investments are going, as opposed to those who are more reliant upon advisors.
Short question from the audience. Define the 3 wealth segments for folks.
Oh, sure. Mass affluent is households with $100,000 to $1 million of net worth. Millionaires are $1 million to $5 million of net worth, and ultra high net worth are those with $5 million to $25 million. Thanks. Page 17 goes into a little more in depth into what this report really will tell you if you should happen to want to look more into it. So for example, we pulled out one of the segments of people who are using independent financial planners as their primary advisor. So what is that we find out about them? Well, for example, a lot of them are baby boomers, 70%. Only a very small percentage of millennials are actually looking at them, but 12% of Gen Xers are looking at financial planners, which is an interesting kind of finding, because Gen Xers are people who sometimes haven't chosen an advisor yet and are really a prime age group that advisors should be targeting. You can see that 61% are males, and the working retired is about equal for those who are using independent financial planners. People who use an independent financial planner are fairly knowledgeable, but feel like they have a lot to learn. Some of them think they're very knowledgeable, but compared to some of the other segments, they kind of fall more into the what I would say upper confident category, but not overly confident category. These people will talk to their advisor about almost half of their assets, and they'll control about 25% on their own, and then they'll turn another quarter entirely over to a professional advisor and say, take care of this for me. The 25% that they tend to control on their own oftentimes may be in a separate online brokerage account, or it may be the things that they're investing in that may be things like real estate or those types of investments. Or because we're including all the way up to 25 million, it could in some cases be, private equity types of investments. So that's the kind of information this report will give to you if you're interested in pursuing it.
One of the things that is in the report that Kathy touched on briefly was the number of folks that are using banks, younger people in particular. In the last couple of years, we've noticed in our research that it's always been quite easy to stereotype millennials and Generation X investors don't have money yet, and a number of them don't. But there is a pretty significant group of millennials and Generation X who are just as wealthy as the older folks in each of these wealth segments.
Correct.
Meaning, if you think of ultra high net worth, which is 5 to 25 million, there's the same percentage of younger investors who are worth 5 to 25 million as folks who are World War II and baby boomer in terms of market size. And so it's been quite easy for the advisor and provider industry to ignore the younger investors or assume they're all going to use robo-advisors. The other thing, as Kathy said, younger folks, because of the relationships that they've had with banks, it's a prime opportunity for those of you that are in the bank world to hold on to these clients. And because historically, we would see that younger investors would leave banks around the age 30 and shift to different types of advisory firms. And yet all the banks have the capabilities that everybody else has these days. So the opportunity is pretty significant as money is beginning to actually shift. Everybody talks about the multi-generational wealth transfer. We actually are starting to see it in Generation X and millennials for the first time, where money is actually now in their families as opposed to their parents or grandparents.
So if you have any interest in this report, just let us know. It's less, I think it's $795. It's not as expensive as some of the others. And it can help, it gives you tips on if there are different types of, there are things you can do to attract individuals who are already at a different type of advisor to whatever type of advisor you might be. The last thing I wanted to touch on is we have our High Net Worth Insights newsletter that you can always request a copy of it from us. And it's an annual subscription, $245 a year. It gives you a lot of information every month, some in-depth information about some of the research that we're doing. And for example, the table of contents is on page 19, and one is about joint decision making, one's about age, working with female investors. Those are the types of articles that we have. So you will receive an email following this where you will be able to download, I think, a copy of this webcast, as well as you will have access to any of the information that was available here today. And if you have any questions, please feel free to follow up with us. Anything else you want to add?
Well, thank you very much.
Thanks. Have a great day.